Several of you have been asking in the comments whether buying gold and silver right now is a mistake. Prices have been swinging all over the place. People keep buying dips that keep dipping. And some buyers are starting to feel like the whole thing is a trap. Today we are going to separate fact from fiction. And you are going to walk away feeling smarter and calmer about how to approach this market. This is Go Finance. Here's what I keep hearing. Do not buy yet. Wait for a lower price. The dip is not the bottom. Gold could fall more. Silver could fall even harder. If you buy now, you will regret it. And on the surface, I understand why that sounds convincing, because parts of it are true. The market has been rough. Gold has been trading around the mid $4,000 range and silver around the upper 60s after a violent reset from earlier highs. This month has been one of the ugliest pullbacks gold has seen in many years. Silver has taken an even harder hit on a percentage basis. That part is real. Also real is the fact that silver usually moves with more drama than gold. Gold tends to have broader demand and deeper liquidity. Silver has the industrial side, thinner spots in the market, and it can behave like the caffeinated cousin in the family. When silver runs, it really runs. When it drops, it does not ask permission. But the conclusion people draw from all of this and stay away completely is still too neat for a market this messy. There's a bigger context a lot of people miss. Last year, gold demand was exceptionally strong by historical standards, with big flows into investment products, strong bar and coin demand, and continued central bank buying. That does not mean price has to go straight up from here. We have just watched a brutal correction. But it does mean this market is being pulled by deeper forces than one ugly month on the chart. And that is why you have to be careful not to let the most recent red candles do all of your thinking for you. Here's the logical leap people keep making. They go from this market is volatile to therefore you should stop buying. And those are not the same thing. The real mistake here is not as simple as buying before the exact bottom. If you are waiting for the perfect bottom, you are already setting yourself up for frustration and maybe even paralysis. And that is where a lot of people lose the plot. Is there a time to buy and a time not to buy precious metals? Yes, but not in the simplistic way people say it. If by not buy, you mean do not go all in with rent money, do not empty your savings, do not treat silver like a lottery ticket, then yes, absolutely. There's a time not to buy. There's a time to wait. There's a time to size down. There's a time to do nothing. But if by not buy you mean freeze completely until some magical all-clear signal appears on your screen, that idea is incomplete. For long-term savers, it is often not about finding the perfect moment. It is about not making the fatal mistake. And the fatal mistake is usually not buying a little too early. The fatal mistake is buying in a way that leaves you exposed, emotional, overconfident, and forced to sell later when the market is down. That is the mistake that really hurts. Why do people confuse these two things? Because price gives you instant feedback. If you buy today and price drops tomorrow, your brain tells you that you were wrong. If you wait today and price rises tomorrow, your brain tells you that you missed it. Either way, the market can make you feel foolish almost immediately, but immediate feedback is not the same as final truth. Think of it like stepping onto an escalator that pauses for a second before it starts moving. In that first moment, you may think you stepped onto the wrong one, but the direction is not always obvious in the first few seconds. Markets create emotional snapshots. People then mistake those snapshots for the whole movie. Now let me share something personal, because this is where the lesson becomes real. I bought a new coin release in both gold and silver. Beautiful pieces. The kind that are easy to justify because you like the design, you like the series, and you tell yourself that even if the market chops around, at least you bought something you actually enjoy owning. When I made that purchase, I did not buy at the exact peak. The market had already pulled back. There had been a dip. And like a lot of people, I looked at that dip and thought, maybe this is the chance. That sounds reasonable, right? That is how these mistakes happen. Not through recklessness, sometimes through reasonableness. That is what makes this so tricky. For a brief stretch, after I placed the order, the market moved in my favor. I was sitting there thinking maybe I timed this decently for once. And then just like that, the floor moved again. Gold rolled over, silver rolled over harder. By the time the order finally showed up about 6 weeks later, I was looking at a loss of just over $500 on that purchase. Nobody enjoys opening a package they were excited about and realizing the market value is now well below where they bought it. That is not a fun little surprise. But here is where people learn the wrong lesson. They think the lesson is never buy the dip. No, the lesson is a dip is not the same thing as a bottom. Those are different. A dip can be the start of stabilization. A dip can be a pause before another leg down. A dip can be nothing more than a breather and a bigger unwind. Nobody knows in real time which one it is. That is why all the chest-thumping certainty on this topic should make you nervous. Anyone who talks as if they know exactly where the true bottom is probably does not. And even when they guess right, a lot of that is hindsight dressed up as wisdom. Here is another place where people get themselves into trouble. They measure every buy like it was supposed to be a trade. That is a huge mistake. If your goal is short-term profit, then yes, timing is everything. If your goal is long-term wealth preservation, then timing still matters. But position size, patience, and liquidity matter a whole lot more. Precious metals are not a magic machine that spits out instant gains. They are also not immune from drawdowns. And in a year like this one, that should be obvious to everybody. Gold ripped to record territory earlier in the year and then gave back a meaningful chunk of that move. Silver did what silver so often does. It magnified the ride. On the way up, it looked unstoppable. On the way down, it looked like somebody pulled a trap door. That is not a broken thesis. That is silver being silver. Here is where I want to challenge one more idea that sneaks into a lot of these conversations. People say if you bought and you're down, you made a mistake. Maybe, maybe not. Sometimes you did make a mistake. Sometimes you paid too much premium. Sometimes you bought for the wrong reasons. Sometimes you bought money you could not afford to leave alone. But simply being down shortly after buying does not automatically prove the decision itself was bad. It may only prove that your timing was imperfect. Imperfect timing is basically part of the admission price in this market. The bottom does not send you a postcard. It does not ring your doorbell. It does not announce itself with a neat sign that says, "Safe to buy now." People imagine the bottom like a line on a chart. It is not. It is more like a foggy stretch of road where only later do you realize that was the turn. So what do? This is where dollar cost averaging earns its keep. And I know that sounds boring. It is boring. That is kind of the point. Dollar cost averaging is not exciting because it is not designed to make you feel clever. It is designed to keep one decision from carrying too much weight. Imagine you walk into a cold swimming pool. If you jump in all at once, that shock hits hard. If you go in gradually, your body adjusts. The water is still cold either way, but the experience is very different. That is what spreading purchases over time does. It does not remove volatility. It changes how much one bad moment can hurt you. Dollar cost averaging does not guarantee the best price. It does not guarantee profits. What it does is reduce your dependence on being exactly right one single time. That is huge, because most people do not blow themselves up by being slightly early. They blow themselves up by being massively concentrated at the wrong moment. Now here is a piece that matters just as much and not enough people talk about. Cash, plain old accessible cash, dry powder, emergency money. A lot of people in this space love the idea of holding wealth outside the system. I understand the appeal. I get the philosophy. But if you do not keep enough liquid savings on hand, then a temporary downturn can turn into a permanent loss because you get forced to sell at the wrong time. That is what cash helps prevent. Not because cash is perfect, not because banks are saints, not because inflation stopped mattering, but because flexibility has value, a lot of value, sometimes more value than squeezing out one extra ounce at the wrong moment. This is why the phrase "there is a time not to buy" needs a better explanation. Sometimes the correct move is not never buy. Sometimes the correct move is not with this money, or not with this size, or not without keeping a cushion. That is a much more useful framework. Now let me go back to that purchase for a second, because there is another layer. Part of why I was okay making that buy is because I liked the pieces themselves. But that also complicates the decision. When you mix stacking with collecting, you are no longer making a pure metal buy. You're making a blended decision, part metal, part premium, part emotion, part taste. And once you admit that you can judge the purchase more fairly. A collectible piece is not the same thing as a low premium stacker round. People blur those categories all the time and then act surprised when the outcome feels mixed. Of course it feels mixed. The motive was mixed. That does not make it wrong. It just means you should be honest about what you were doing. Let us talk about the big story that always comes up after a drop. This proves I should have waited. Maybe. But waited for what exactly? For lower prices? How much lower? And how would you know? What if the price never comes back to the level you want? What if it touches that level for 20 minutes while you are busy doing something else? What if it never quite gets there and then takes off? Are you buying then, or are you still waiting? This is the trap. People talk about patience like it is a clean decision. A lot of times it is not patience. It is disguised fear. Fear can be useful sometimes. Fear can save you from overextending. Fear can stop you from chasing a vertical move after everyone has already gotten bullish. That kind of fear helps. But fear can also keep you permanently on the sidelines. And being permanently on the sidelines has its own cost, especially in a market where the longer-term backdrop can still be supportive, even after a nasty correction. Recently published market research showed that gold demand last year reached record territory, helped by strong investment flows and heavy buying in bars and coins. Central banks also kept buying at a pace that remained historically strong. In other words, the bigger backdrop did not vanish just because the market had a rough month. Short-term pain and long-term thesis are not always the same conversation. Now let me summarize the actual mistake, because this is where people still get confused. The mistake is not that you bought and the market fell afterward. That can happen to anybody. The mistake is buying without a plan for what happens if it falls afterward. Very different. If you buy and the price drops, but you still have cash, still have time, still like your allocation, and still believe in why you bought it, then you may be annoyed, but you are not trapped. If you buy and the price drops and now you are stressed, stretched, second-guessing, and thinking about selling because you need the money, that is where the real damage starts. So before you buy another ounce, ask yourself a better question. Not, is this the bottom? Ask, if this drops more, am I still okay? That is the better question. And if the answer is no, then maybe you do not need a better chart. Maybe you need a smaller order, or more patience, or more cash in reserve, or less emotion. That is what risk management actually looks like in real life. Not in theory, not in hindsight, in real life. For me, with that purchase, I'm comfortable continuing to own it because I like the pieces, because the loss is manageable, because I did not use money I needed next week, because I still think the longer-term case for holding some precious metals is reasonable, and because one imperfect entry does not invalidate the broader role these assets can play. That is why I can shrug and say lesson learned. Not because losing money feels good, but because the situation is still within the plan. That is the whole game. You want your mistakes to stay within the plan, not perfection. Containment. You're not trying to eliminate every error. You're trying to make sure no single error can wreck your position, your peace of mind, or your finances. If you are staring at gold and silver today, wondering whether to buy, stop trying to be perfect. Instead, try to be prepared. Prepared for another drop. Prepared for a rebound without you. Prepared for a long wait. Prepared for some amount of regret, because some amount of regret is almost unavoidable, no matter what you do. What you want is manageable regret, not destructive regret. That is the target. We are stackers here. We understand that discipline matters more than prediction right now. Drop a comment below. Have you ever bought a dip and watched it dip again? What bothers you more? Buying too early or waiting too long? I read every comment and I will pin the best ones. If you want this analysis in your inbox every morning before markets open, join the Go Finance newsletter. Every day before the session starts, you get a direct summary of what is moving gold and silver, what the data says, and what to watch. No noise, no headlines, just the information that matters before anyone else has it. Link is in the description and in the first comment below. Subscribe, turn on notifications, data before price. Go Finance. 5 shorts. Short. 1. A dip is not a bottom. I bought the dip. The dip kept dipping. 6 weeks later, I opened the package and I was down $500. Here is what people get wrong about this. They think the lesson is never buy the dip. That is not the lesson. The lesson is a dip is not the same thing as a bottom. Those are different things. A dip can be the start of stabilization. A dip can be a pause before another leg down. A dip can be nothing more than a breather and a bigger unwind. Nobody knows in real time which one it is. The bottom does not send you a postcard. It does not announce itself with a sign that says, safe to buy now. Anyone who talks as if they know exactly where the true bottom is probably does not. Subscribe for the full breakdown. Short 2. The fatal mistake is not what you think. The fatal mistake in precious metals is not buying a little too early. The fatal mistake is buying in a way that leaves you exposed, emotional, overconfident, and forced to sell later when the market is down. Most people do not blow themselves up by being slightly early. They blow themselves up by being massively concentrated at the wrong moment, by using money they could not afford to leave alone, by buying without a plan for what happens if prices fall further. Ask yourself a better question. Not, is this the bottom? Ask, if this drops more, am I still okay? If the answer is no, then you do not need a better chart. You need a smaller order, more patience, or more cash in reserve. Subscribe for the full analysis.